When most traders see a small gain, they hit sell. They think locking in profit equals safety. That realizing a win, no matter how small, is the smart move. But Jesse Livermore would call that suicide by comfort. The market's greatest illusion isn't loss. It's the illusion of control that comes from a quick win. Here's the brutal truth. Most amateurs never lose because of bad entries. They lose because they never let their winners breathe. They choke opportunity the moment it begins to grow. They take comfort over compounding. Livermore once said, "The big money is made by sitting, not thinking." He didn't mean sitting idly. He meant sitting right, waiting for proof, waiting for confirmation that the market, not emotion, is on your side. The amateur trades for excitement. The professional trades for confirmation. Livermore's 1/5 rule was his antidote to the disease of premature safety. When a position moved in his favor, he didn't cash out, he added. He scaled into success instead of fleeing from it. Each addition was 1/5 of the original risk, placed only when the market proved him right. It wasn't gambling bigger, it was rewarding proof. The rule made him ruthless about only risking more once he'd earned the right to do so. Imagine two traders watching the same breakout unfold. The first takes a small 3% gain and exits. He feels smart for locking profit. The second, following Livermore's philosophy, waits. He studies the tape. He sees price holding strong on rising volume, weakness failing to appear. That's confirmation. He adds another 1/5. As the trend strengthens, he adds again. By the end of the campaign, Trader A has made lunch money. Trader B has made a year's salary. That's the hidden paradox in trading. The small win that feels safe is often the seed of a much larger mistake. The amateur sells to soothe emotion. The professional holds or even builds because he knows the market is offering proof, not pain. Livermore's genius was realizing that the early stages of a profitable move are not endings, they're beginnings. Most people can't handle that. Their minds are wired for comfort. When you see a small gain, your brain releases dopamine, the reward chemical. It whispers, "Take it now. Feel good." Professionals fight that impulse every single day. They understand that discipline means resisting emotional comfort in favor of structural confirmation. Livermore's 1/5 rule turned that discipline into a system. He forced himself to only add when the market itself paid for the risk. He once described his process like a general advancing troops. "Never move until your flank is secure," he said. "The first 1/5 goes in at the breakout, the probing attack. If it holds, add another 1/5. If the market confirms strength again, push further. But the moment it falters, stop, fall back." Each addition is a strike launched from strength, not hope. Hope, in trading, is poison. You can't pyramid on hope. You can only pyramid on proof. The amateurs hope a small win becomes big. The professionals demand the market prove that it deserves more of their capital. This single distinction is what separates the hobbyist from the operator. Livermore used to say that the real work in trading isn't finding the setup, it's managing the emotion once you're right. That's where the money is made or lost. Anyone can buy. Only the disciplined know when to hold and when to build. And ironically, that choice to keep holding while the market climbs is one of the hardest acts in finance, because every tick against you, every wobble, whispers fear. The amateur hears that whisper and acts. The professional listens but waits for the tape. Livermore would watch the tape, those old ticker prints, looking for rhythm, for behavior. When he saw orderly demand and controlled supply, he added another 1/5. If he saw chaotic reversals, he'd freeze all action. "Never add unless the market acts as it should," he told a reporter once. To the outside world, this patience looked like luck, but it was process measured, mechanical, mercilessly rational. The 1/5 rule wasn't an invitation to overtrade. It was a constraint that forced clarity. You couldn't add just because you felt good. You could only add when the market validated your bias through behavior. That's why Livermore rarely lost big. Every 1/5 had its own logic, its own checkpoint of proof. Most traders don't build that kind of structure around success. They build rules around failure, where to stop out, how much to lose, but never rules around winning. That's why they never grow. The 1/5 rule flipped that dynamic. It made winning systematic. You earned the right to expand only when the market confirmed your competence. Think about the psychological inversion here. The amateur feels bold when adding to a losing position, convinced the market will turn back. The professional feels bold when adding to a winning one, because the market has already proven him right. One approach feeds ego, the other feeds results. Livermore's brilliance was designing a process that rewarded truth and punished hope. This wasn't theoretical. In one of his biggest campaigns, Livermore rode a stock from 60 to over 200 by applying the 1/5 structure with almost military precision. He started small, just 1/5 of his intended size. The first breakout held, so he added. The second surge confirmed strength, so he added again. By the time the move had matured, his initial probe had grown into a full position, built entirely on profits, not original capital. That's compounding through discipline. That's the math of patience. The amateur, by contrast, would have sold at 70, satisfied with a 15% gain. He'd feel like a genius until he saw the stock triple without him. That pain of missed opportunity is worse than any small loss. Livermore understood that. Discomfort too. But he also knew that chasing comfort is how traders quietly die. He built emotional armor through rules. The 1/5 rule wasn't about percentages, it was about self-control. Each addition was a psychological checkpoint. Do I have confirmation, or do I just want to feel good? That single question separated his fortune from his ruin. There's another layer to this rule: risk compression. Because each fifth is smaller relative to total profit, the later additions are funded by the market itself. You're not increasing absolute risk, you're reallocating internal capital. The result? Compounding upside with capped downside. The professional thinks in probabilities and process. The amateur thinks in wishes and fears. The true brilliance of Livermore's approach is that it forces patience in a world that punishes waiting. It rewards observation, not prediction. It builds conviction through data, not dopamine. Every fifth added is a conversation between you and the market. You've proven me right, so here's more capital. That's not gambling. That's partnership. It also explains why Livermore was never obsessed with being first. He didn't care about buying the bottom or selling the top. He cared about catching the middle, the meat of the move. That's where professionals eat. The first fifth is reconnaissance. The rest is reward. The amateur brags about perfect entries. The professional brags about perfect confirmation. Livermore once joked that amateurs want to be right at the beginning, while professionals prefer to be right eventually. That single line captures the spirit of the 1/5 rule. You don't need to be first, you just need to be disciplined enough to hold and build when the proof is undeniable. And here's the twist most people miss. The 1/5 rule wasn't about greed. It was about discipline under confirmation. The amateur takes profit to feel safe. The professional scales because he's earned the right to risk more. The difference between those two mindsets determines everything about your equity curve, your confidence, and your survival. So, if you find yourself itching to sell the moment you're green, pause. Ask yourself, am I exiting because the market changed, or because my emotions did? If it's the latter, you're not trading, you're escaping. Livermore's 1/5 rule exists to rescue you from that reflex. It's the system that transforms reaction into reason. In the end, this isn't just a trading rule. It's a philosophy of patience, proof, and professional behavior. The market rewards those who wait for confirmation and punishes those who seek comfort. Livermore mastered that balance. He didn't chase every move. He stalked the few that proved themselves worthy. That's why he built fortunes, while others blew up chasing feelings. And as you'll see in the next chapter, his scaling wasn't random. It was strategic. Every fifth had purpose, structure, and a precise trigger based on tape behavior. Each move was a calculated strike, not a blind bet. The system was simple. The execution was art. And it all began with understanding that taking profits too early isn't caution. It's self-sabotage disguised as wisdom. Livermore didn't think in trades, he thought in campaigns. Each position was a military operation, advanced in 5 deliberate strikes, each measured, each tested, each built on confirmation. This was the essence of his 1/5 rule. Risk 1/5 of intended exposure. Wait for proof. Then pyramid carefully. Step 1 was always the reconnaissance move. The first fifth went in at the breakout point, what Livermore called the pivotal point. This wasn't speculation. It wasn't hope. It was a calculated test of strength. Step 2 only came once the market confirmed the initial move. Price had to hold. Volume had to expand. The tape had to speak clearly. Only then would he add another fifth. If the market reversed at any stage, the protocol was simple. Exit immediately. The rule kept risk proportional, capital controlled, and his mind sharp. He learned this lesson the hard way in the cotton market. Early in his career, Livermore had entered too heavy, risking too much before confirmation, and the market crushed him. The losses weren't massive, but they were painful and illuminating. Later, he noticed how syndicates operated. They never threw all their capital into a single breakout. They probed. They observed reactions. They adjusted their strikes according to evidence. The professional's edge wasn't in being first, it was in being right and disciplined. Prediction was amateurish. Testing was professional. Each fifth added was proof that the market had granted him permission to increase exposure. This mindset transformed small gains into monumental runs. Imagine a trader without discipline, watching a stock rise and adding impulsively. One misstep, and the accumulated gains vanish. Livermore's approach avoided that by framing each addition as a vote of confidence confirmed by market behavior. The first fifth is reconnaissance. The second fifth confirms commitment. The third and fourth fifths capitalize on established momentum. By the fifth addition, risk is largely internalized. The market is funding the growth, and capital outside the position is largely protected. Each fifth is structured. Each fifth is rational. Each fifth is earned. Emotion has no seat at the table. Livermore likened this approach to a syndicate because it mirrored the disciplined operations of institutional trading, even when he was acting solo. Syndicates didn't gamble, they pressed only when the setup was proven. They moved like a predator, probing territory before committing fully. The amateur, in contrast, sees a green candle and attacks in panic or excitement. The professional watches, observes, and allows the market to guide each incremental move. That discipline creates leverage not through size alone, but through timing and validation. Step 1 in this campaign is crucial. The initial fifth enters at the breakout, the pivotal point. It is never too early and never too late. Livermore observed that entering early without confirmation often led to shaking out small accounts. Entering late meant missing the real gains. But of you 2%, than constented are exputed and risen, for my still were 2%, than constented every 2. The pivot is identified not by opinion, but by tape behavior. Price stability, volume trends, and relative market strength are the signals. The amateur seeks patterns. The professional reads behavior. This difference in approach turns what seems like inaction into strategic advantage. Step 2, the confirmation add, is where the 1/5 rule begins to compound advantage. Here, the professional tests patience. If the first fifth moves as expected, another fifth is allocated. If not, the position is trimmed or left alone. This ensures that exposure scales with proof, not hope. A small initial gain is never treated as victory. It is the market saying, "You are right so far. Do you want to commit more?" The answer is dictated by evidence, not ego. Every incremental fifth added is an experiment validated by results. In the cotton market, Livermore had learned that impulsive scaling led to catastrophic losses. He saw syndicates behave differently, advancing in measured steps, always reacting to market feedback. The tape is merciless. It reveals strength or weakness without bias. The professional's role is to observe, interpret, and act only when the market speaks clearly. Each fifth added is a signal that the market continues to align with the thesis. Scaling like a syndicate is as much about psychological discipline as capital management. Each addition tests patience, nerve, and adherence to process. The amateur wants action for excitement. The professional wants proof for confidence. This discipline also creates flexibility. If the market reverses, losses are contained because each addition is small relative to the total intended exposure. Risk is distributed across incremental confirmations, not concentrated on impulsive conviction. This is the safeguard against the psychological hazards of early success. The 1/5 rule also formalizes compounding. By allowing the market to fund the subsequent additions, the professional benefits from growth without exposing the entire original stake to risk at once. Each fifth becomes a vehicle for controlled leverage. The amateur gambles everything on early signs, often forfeiting long-term gains for short-term comfort. Professionals, through the discipline of incremental scaling, achieve magnified results while preserving mental and financial capital. The first fifth is about testing. The second fifth is about validation. The third and fourth fifths capitalize on the proven trend. By the fifth, the professional has fully committed, but always with awareness that each step was conditional on market proof. The amateur, by contrast, acts in reaction, guided by emotion, often overexposed before the trend is confirmed. This contrast illustrates why so many traders fail. The timing and scaling are not grounded in evidence. Discipline transforms potential gains into realized profits. The cotton market anecdote provides a vivid illustration. Early mistakes taught Livermore the importance of testing before commitment. Syndicates demonstrated the power of measured escalation. By adopting a staged approach, he transformed small opportunities into significant campaigns. The analogy to a military advance is apt. Reconnaissance, probing, confirmation, consolidation, and final exploitation. Every fifth corresponds to a strategic step, guided by evidence, not hope. Professional traders understand the paradox. Sometimes, the best move is inaction. After scaling, there are moments when no further trades are warranted, not because nothing is happening, but because waiting itself is a position. The amateur misinterprets inactivity as indecision or weakness, but the professional recognizes it as control, as patience weaponized. After adding 1 or 2 fifths, the market may pause, and the disciplined trader watches. The best trade is often no trade, allowing momentum to unfold on its own terms. This controlled approach also tempers ego. Each addition is a test of humility. The professional understands that proof precedes size. Each fifth is a checkpoint. Does the market confirm my view, or am I wishing it would? This repeated assessment builds both confidence and resilience. The amateur fails here, mistaking hope for certainty, leading to impulsive scaling or premature exits. The 1/5 rule formalizes a framework where emotion is systematically excluded from decision-making. Livermore's methodology also illustrates risk efficiency. By committing only partial exposure at first and scaling with confirmation, he managed drawdown potential while allowing for compounding upside. The tape dictates allocation. This approach doesn't maximize individual profits on early wins. It maximizes net results across the entire campaign. The professional's mindset is cumulative. Small, disciplined steps compound into significant gains. The amateur seeks immediate gratification and fails to build durable capital. The syndicate analogy reinforces the mindset difference. Just as institutional operators move in stages, Livermore adopted a disciplined approach as a solo trader. Observation, incremental commitment, and evidence-driven decisions create both financial and psychological leverage. Scaling becomes systematic, predictable, and aligned with the market's behavior rather than personal desire. Every fifth added under the 1/5 rule is a calculated strike, not a blind bet. The first fifth tests conviction. The second confirms behavior. The third and fourth exploit momentum. The fifth consolidates gains while maintaining structural discipline. Each step is a dialogue with the market, ensuring that exposure is, quote, rational, proportional, and timed. This disciplined escalation is what allows small wins to evolve into monumental runs without undue risk. Even in modern markets, the principle holds. The psychology behind incremental scaling, confirmation, and disciplined compounding is timeless. Professionals leverage proof, amateurs chase patterns. The one-fifth rule formalizes this difference, converting observational discipline into replicable strategy. Evidence dictates allocation. Hope is excluded. This structural advantage is why Jesse Livermore's campaigns succeeded where amateurs failed. The paradox of scaling is that sometimes, after careful addition, the best action is still inaction. Waiting after building a partial position is an offensive strategy, not a passive one. Each addition has earned its place. Now the trader must sit, observe, and let the market dictate the next move. In Chapter 3, we'll explore how waiting itself becomes the most aggressive trade in Livermore's toolkit. Livermore once said, "It was never my thinking that made big money. It was always my sitting." That phrase alone encapsulates a principle that most traders consistently misunderstand. Waiting is not passivity, it is strategy. The amateur hears silence and panics, convinced that inaction is weakness. He fidgets, clicks, buys, sells, and reacts to every tick, mistaking movement for control. The professional, however, hears the same silence and listens. Every moment of inaction is a data point, a pulse of market behavior to observe, interpret, and respect. Waiting, when done with purpose, is an active position. It is the kind of patience that separates amateurs from the true operators of capital. When Livermore pyramided his positions, he often went days or even weeks without placing a single new order. Each day without action was intentional, not lazy. He treated inactivity as an extension of his strategy, a position in itself. Markets are not machines. They are mirrors of human emotion. The crowd is volatile, impulsive, and restless, which is why so many traders fail. They cannot tolerate the silence, the uncertainty, or the waiting. They act, and in doing so, they hand their capital to those who can wait. This is the professional advantage, to treat time as an ally, not an enemy. A perfect example of this principle in action comes from one of Livermore's most famous campaigns, Union Pacific. After entering a position and adding a second fifth following confirmation, he faced a lull in price movement. Days passed with little change, nothing worth reacting to. The tape was quiet. The volume was steady but unremarkable. Many traders would have panicked, reduced exposure, or exited entirely, fearing the move was over. Not Livermore. He did nothing. He held his existing positions, watched the tape, and allowed the market to reveal its intentions. Weeks later, a clear confirmation emerged. Price held, volume expanded, and the trend reasserted itself. Livermore added a third fifth and, in the following days, doubled his account. The profits were not the product of action, they were the result of disciplined waiting. The lesson here is profound. Waiting protects both your profits and your mind. Each fifth added to a position must earn its right, not merely through price movement, but through time. Time filters out the noise, exposes false signals, and distinguishes genuine momentum from temporary spikes. Motion in the market is not always meaning. Without patience, traders conflate volatility with opportunity and frequently pay the price. The professional understands this distinction. He recognizes that inactivity, when purposeful, is an instrument of precision. Patience in trading is counterintuitive. The human mind craves action, rewards itself with dopamine from doing something, and punishes stillness. The amateur feels compelled to trade in response to minor market movements, believing that not acting is the same as losing. The professional knows that true advantage comes from choosing when to act, not just from acting. Livermore treated waiting as a calculated measure. He watched for patterns of confirmation, tested the market with small increments, and allowed the position to grow organically. Each addition, each fifth, was sanctioned by the market itself, validated through sustained behavior, rather than opinion or hope. Even seasoned traders struggle with the mental discipline this requires. Watching a position stagnate while capital sits idle can be excruciating. Fear whispers, "The market is moving without you. Act now or miss out." Greed whispers, "You could add more, take more, push the position." The professional filters these impulses. He interprets the tape, he observes the behavior, and he places trust in the evidence, not emotion. This trust is cultivated through repetition, experience, and adherence to structured rules. Livermore's Union Pacific campaign highlights the principle perfectly. During the weeks of stagnation, he did not panic, he did not hedge unnecessarily, and he did not add without confirmation. He was fully engaged, reading the tape, noting volume shifts, monitoring relative strength but outwardly inactive. That is the paradox. The most aggressive trade can be doing nothing at all. By allowing the market to validate his position, Livermore minimized unnecessary risk while maximizing opportunity. The amateur would have been trapped in a constant cycle of overreaction, whereas the professional capitalized on deliberate patience. The strategic pause also amplifies the effect of subsequent additions. When the third fifth was finally added, it carried more weight because it was fully validated. Earlier increments had already tested the market's resolve, built confidence, and allowed the trader's own conviction to mature. Compounding gains in this way is far more reliable than chasing momentum from the outset. The amateur seeks instant gratification, expecting every green candle to become a big winner. The professional understands that sustained profitability requires both timing and patience. Waiting, in this context, is a skill that must be practiced and respected. It is not passive avoidance, it is vigilance. The tape provides constant feedback: price, volume, volatility, market breadth, but only those who wait long enough can interpret it correctly. Every failed test, every reversal, every insignificant candle teaches the disciplined trader something essential about the market's character. Inaction is never wasted if it informs future decisions. The professional uses waiting as a lens to distinguish strength from weakness, trend from noise, and opportunity from illusion. The mental benefits of this approach are equally important. A trader who can accept the power of waiting gains emotional stability. He is not driven by fear, impatience, or greed. He knows that every fifth added is conditional, every action is sanctioned by proof, and every period of inactivity is intentional. By contrast, the amateur is constantly reactive, perpetually stressed, and prone to errors that compound over time. Discipline in this sense becomes both a psychological and financial advantage. The 1/5 rule intersects with waiting in a natural way. Early editions are about testing the waters. Later editions are about confirming strength. The gap between each increment is an interval for observation. Some days the market does nothing meaningful. The professional uses this time to listen, to observe tape patterns, and to prepare for the moment when evidence finally arrives. The amateur interprets this quiet as weakness, often exiting prematurely or making unnecessary adjustments. The professional interprets it as opportunity, the calm before the next decisive wave. One of the subtler insights from Livermore's experience is that waiting also tempers ego. When you do not act impulsively, you avoid the pitfalls of overconfidence. Every fifth is earned, not assumed. The trader must constantly verify that the market's behavior aligns with expectation. This fosters humility and reduces overextension. The amateur, lacking this discipline, confuses movement with insight and often overcommits, only to be punished by natural market reversals. Patience, as Livermore demonstrated, is precision delayed. It is a deliberate choice to observe before acting, to measure before committing, and to verify before escalating. The third fifth in Union Pacific was not a gamble, it was a carefully timed, fully sanctioned addition, made possible by weeks of observation, measurement, and confirmation. This is what separates professionals from amateurs, the ability to translate inaction into opportunity. By the time the trend fully unfolded, the position had grown organically, with risk managed at every stage. Compounding was methodical, exposure controlled, and confidence earned through observable proof rather than hope. Every fifth had its own justification, and every pause between additions ensured that the overall position remained resilient against unexpected reversals. The disciplined trader, therefore, achieves both growth and safety simultaneously. The lesson extends beyond any single stock or market. Waiting is universal, a principle that applies to any trade, any time frame, and any asset class. Markets will always fluctuate, but the disciplined observer gains the advantage by letting time and behavior validate decisions. To act prematurely is to invite error. To wait strategically is to exploit opportunity. Inaction, when guided by proof, becomes a position of power, a weapon against impulsive behavior, and a catalyst for compounding success. The amateur views waiting as inactivity. The professional understands it as a force multiplier. Each fifth added, each pause observed, is part of a larger orchestration, a disciplined symphony of capital and conviction. Waiting protects the mind, conserves capital, and enhances long-term profitability. Livermore's genius was recognizing that moments of silence, when properly leveraged, can yield outcomes far greater than frantic activity ever could. And yet, this approach is psychologically challenging. To sit while profits accumulate, to observe while the crowd reacts, requires trust in both the market and oneself. The professional develops that trust through repetition, process, and respect for evidence. Waiting is never wasted if it is purposeful. And in fact, it is the most aggressive trade a disciplined operator can make. The Union Pacific example crystallizes this principle. 2 initial editions had already established the structure. The market paused, testing patience, and the tape revealed nothing actionable for weeks. Livermore held, watched, and allowed time to filter noise. When the confirmation finally appeared, he made the 3rd edition decisively, and the reward was magnified precisely because of the waiting. Every fifth gained credibility. Every period of observation paid off. Inaction, when intentional, amplifies the impact of subsequent actions. Waiting filters out false signals, protects capital, and allows conviction to mature. It converts potential into reality, evidence into profit. The amateur misinterprets quiet as weakness. The professional understands it as strength. The gap between action and inaction is where compounding occurs, where risk is managed, and where real opportunity lives. Waiting is not merely an avoidance of error. It is the strategy that enables the 1/5 rule to function at its highest level. By respecting intervals, observing behavior, and allowing the market to confirm trends, the disciplined trader creates a structure for both risk control and compounding growth. Time becomes a co-conspirator, not an enemy. Patience is the catalyst that turns small, confirmed moves into major victories. And as we transition to the next chapter, it is crucial to understand the tension that accompanies patience. Even the most disciplined strategies can be undermined by ego. In Chapter 4, we will explore the dark side of pyramiding, showing how even Livermore's most potent weapon, careful scaling and patient waiting, can turn into a trap if the operator allows pride, overconfidence, or impatience to dictate action. Understanding patience as power sets the stage for recognizing its vulnerabilities, and for learning how professionals safeguard themselves against the subtle seductions of ego-driven decisions. Every professional faces one enemy stronger than the market: ego. It lurks quietly behind wins, whispers in the pauses between trades, and disguises itself as confidence. Jesse Livermore's 1/5 rule worked brilliantly until he broke it himself. Years of success had hardened his trust in intuition. He began to believe he could sense the market's next move without waiting for confirmation. The discipline that once protected him faltered. He scaled too soon, added too aggressively, and in a cruel twist, watched millions evaporate. It wasn't the market's fault. It was his own hubris. This is the shadow side of success. Proof becomes assumption. Amateurs lose through fear, exiting too soon, overreacting to volatility. Professionals, paradoxically, can lose through overconfidence, believing they are smarter than the market itself. Livermore knew the market always humbles the proud. The danger is subtle. You follow your own system faithfully for months or years, and slowly, you start to trust yourself more than the rules. You interpret confirmation where none exists. You ignore subtle warning signs. That's how giants fall, not in one catastrophic trade, but gradually, through repeated self-deception. A story from 1931 illustrates this perfectly. Livermore was long steel stocks, convinced of an imminent recovery. His conviction was absolute. The tape, however, painted a different picture. Lackluster, volume, failed rallies, and hesitant price movement. The disciplined approach would have been to scale only with evidence or to step back entirely. Instead, Livermore's ego overrode his rules. He doubled down, believing his insight alone justified risk. The result was catastrophic. Losses that erased years of careful, disciplined gains. That single failure was not market misfortune, it was self-inflicted. Every fifth he added that day violated his own principles, and the market punished him mercilessly. The lesson is stark. The 1/5 rule is not merely a tool for growth. It is a mirror for humility. Each fifth added is a test not just of market conditions, but of personal restraint. Without humility, pyramiding becomes self-destruction, masquerading as conviction. Confidence, unchecked by proof, is no different than hope. Professionals must constantly ask themselves, am I adding because the market confirms, or because I want to be right? The second is the ego trap, a silent killer of otherwise sound strategy. Ego often masquerades as creativity, insight, or brilliance. A trader begins to rationalize deviations from the rule. The tape will turn. I feel it in my gut. I've done this before. These justifications sound reasonable internally, but externally, the market doesn't care about gut feelings. It responds only to behavior, volume, price, and trend. The amateur exits from fear. The overconfident professional exits from punishment. History is littered with traders who mistook intuition for proof and watched fortunes vanish. Even legends are vulnerable. Livermore's career was punctuated by massive wins and dramatic collapses. His genius was understanding market mechanics. His weakness was human nature. That duality makes his story instructive for every trader. Humility is the ultimate edge. Discipline isn't just about sticking to rules. It's about confronting your ego when it tempts you to cheat them. The 1/5 rule formalizes this: confrontation. Every incremental addition must earn its place. There is no shortcut, no substitution for verification. Consider the psychological pressure in scaling. The market moves favorably, profits accumulate, adrenaline spikes, ego whispers, you can risk more now, you know better than the tape. The disciplined professional responds with skepticism, checking confirmation, volume, and behavior before allocating the next fifth. The amateur hears the same whispers and acts impulsively. This difference, subtle in each trade, compounds over time into dramatically divergent outcomes. Humility and process, reinforced consistently, produce lasting results. Unchecked ego produces catastrophic reversals. The steel stock incident also reveals the hidden interplay between conviction and verification. Livermore's intuition was accurate in some respects. He correctly predicted the broader recovery eventually. But his timing was disastrous because he ignored the system of incremental confirmation. The 1/5 rule is designed to protect against exactly this scenario. It's a disciplined firewall against the temptation to act on pride. When followed, it aligns position size with evidence rather than ego, ensuring growth is grounded in reality. Maxims like, "The moment you think you're bigger than the market, you've already lost," are not abstract aphorisms. They are survival instructions. They remind traders that no matter how successful or intelligent, the market operates independently of human pride. Humility allows the professional to leverage gains without courting ruin. Ego ensures that even profitable campaigns can end in disaster. By internalizing the principle, traders create a mental framework that filters out temptation and reinforces process over opinion. Ego's danger is amplified by compounding. Scaling feels rewarding, profits accumulate, and reinforce self-belief. The brain confuses validation with truth. Without strict adherence to the 1/5 rule, each incremental gain can become a justification to exceed limits. 1/5 turns into 2, then 3, until risk outpaces evidence. The professional uses incremental scaling as a guardrail. The overconfident trader sees it as a license to act. That subtle difference determines who thrives and who falters. Historical failures underscore the necessity of humility. Even those who dominate markets for years can be undone when confirmation is substituted with assumption. Livermore's losses in steel were not about the mechanics of scaling, they were about the mind behind it. Professionals must recognize that the rules exist to temper the psyche, not just manage capital. Ego will always push toward premature escalation. Discipline channels that energy into evidence-driven action. The 1/5 rule, when followed, is self-correcting. Each fifth requires proof. If the market falters, exposure is limited. If it succeeds, the addition is justified. This creates a feedback loop between reality and action, preventing the subtle creep of overconfidence. The professional thrives by respecting this loop. The amateur falls by ignoring it. Awareness of ego's influence is as crucial as understanding volume or price action. Even experienced traders can fall prey. Pride manifests quietly. "I know better than the tape," or "I can't miss this trend." The market exploits those thoughts without mercy. Humility is not a passive virtue. It is an active shield. It forces verification, maintains proportional exposure, and protects both capital and confidence. Without it, the most disciplined rules are vulnerable to human error. The steel market episode is a cautionary tale that resonates today. Traders can be highly skilled, observant, and disciplined, yet still fall if they fail to check ego. The 1/5 rule is a practical mechanism for humility, systematically translating verification into position sizing. Each fifth added represents not just capital allocation, but a psychological checkpoint. By adhering to it, professionals ensure that growth is measured, risk is managed, and ego is restrained. Even when markets appear favorable, professionals pause. They ask, "Does this addition follow proof, or am I rationalizing desire?" The disciplined response reinforces the system, ensuring that every move is justified, calculated, and aligned with reality. Amateurs, lacking this checkpoint, accelerate toward ruin. Pride masquerades as insight. Fear of missing out masquerades as opportunity. The professional navigates both with rules, patience, and humility. Ultimately, the ego trap is universal. It is a silent threat lurking behind every win, every confirmation, every moment of apparent competence. The professional's advantage is the recognition that humility is not optional. It is essential. The 1/5 rule operationalizes humility, converting psychological discipline into measurable action. Each fifth is an earned step, a safeguard against overextension, and a tool to translate verified insight into sustainable growth. So, while the 1/5 rule allows for scaling and compounding, it also serves as a mirror. Each incremental addition reflects the trader's capacity for restraint. Every failure to check ego increases risk exponentially. The market is impartial. It does not reward hubris. The lesson is timeless. Respect rules, verify proof, and recognize that discipline is more valuable than intuition alone. Without humility, even the most potent strategy can turn into self-inflicted catastrophe. And now, in the final chapter, We will reveal how Livermore combined these lessons: discipline, patience, incremental scaling, and ego management into a complete framework for cutting losses quickly while letting the giants run, uniting risk control and compounding into a single, actionable methodology. Livermore's genius wasn't in finding entries, it was in survival through subtraction. The market, he understood, is ruthless to anyone who confuses courage with wisdom. The 1/5 rule was his framework for growth, but it could have been deadly without an equally disciplined system for retreat. His secret safeguard was what he called the line in the sand. Every added fifth had its own stop-tight, unemotional, mechanical. When confirmation failed, he erased exposure immediately. There was no debate, no second guessing, no hope. The market dictated the rules. He obeyed. This single principle transformed pyramiding from a risky technique into a sustainable strategy for compounding capital. Think of it like pruning a tree. Weak branches, no matter how promising, are cut to preserve the health and growth of the strong ones. Without pruning, the tree becomes congested, fragile, and prone to disease. Livermore applied the same principle to his positions. When his cotton campaign reversed slightly, he cut the newest edition instantly, without hesitation or regret. That fifth was gone. But the earlier increments, the core position remained intact because the tape still validated them. This selective approach allowed him to ride trends for weeks, sometimes months, without catastrophic losses. Amateurs often fear cutting. They cling to small gains or lagging positions, hoping the market will forgive their misjudgment. Professionals accept that losses are part of the game, and controlling them is the path to longevity. The paradox is clear. Growth comes through disciplined retreat. By culling weak positions while letting proven ones flourish, the professional leverages evidence over emotion. The 1/5 rule isn't about aggressive expansion. It's about precision compounding. Each addition is an opportunity, but only if it earns the right to exist. Each fifth is treated as a separate experiment, each with its own line in the sand. One can fail without jeopardizing the entire campaign. Risk management and compounding are married in this structure, allowing both survival and exponential gains. Even in volatile markets, this approach maintains mental clarity. When a fifth hits its stop, Livermore didn't panic. He didn't chase reversals or double down out of stubbornness. Cutting losses was not a failure, it was a signal that the market was teaching, not punishing. By excising unproven exposure quickly, he preserved both capital and emotional resilience. Holding core positions that still obeyed the tape ensured that momentum could continue to compound. The disciplined rhythm of cut, hold, repeat became a template for professional longevity. Consider the mechanics. The first fifth tests the waters, the second validates strength, the third and fourth exploit momentum, and the fifth consolidates. Each incremental position is monitored independently. A failed addition is removed. Confirmed positions continue to grow. The amateur often blends all positions mentally, panicking if any part falters. The professional isolates risk, acknowledges proof, and allows the structure to function as designed. The tape remains the ultimate authority. Personal desire has no place. This methodology also magnifies the benefits of waiting, a principle explored in the previous chapter. When a fifth fails, cutting it is itself an act of discipline. When a fifth succeeds, adding to it is done only after confirmation. Waiting, therefore, is a dynamic trade, not inaction. Time filters the noise, patience confirms the thesis, and proof determines exposure. Every decision, entry, addition, removal, is anchored in observable reality rather than gut instinct or hope. By respecting these boundaries, Livermore could compound capital while limiting risk exposure at every stage. Maxim: trade like a sniper, add on proof, cut on doubt. This isn't hyperbole. It's an operational philosophy. The sniper waits for the perfect shot, aims deliberately, and acts decisively. He doesn't fire on impulse or emotion. Similarly, Every incremental fifth is added, only when the market proves the setup. Every line in the sand exists to remove unproven positions without hesitation. The professional's edge comes from marrying opportunity with restraint, aggression with humility, and patience with evidence. The cut, hold, repeat rhythm creates a feedback loop of learning and reinforcement. Each action teaches the trader something about the market, their system, and themselves. Cutting a fifth reinforces respect for confirmation. Holding a core position reinforces trust in the tape. Adding a new fifth reinforces confidence in disciplined scaling. This loop transforms repetition into compounding both financially and psychologically. Amateur traders rarely complete this loop. They react, conflate noise with signal, and allow ego to dictate behavior. The professional uses structure to turn lessons into profits. Practical application is simple yet profound. Start each position with 1/5 exposure. Monitor tape behavior and confirm momentum. Add another fifth only when proof is clear. Assign stops for each increment. Cut immediately if the market erases confirmation. Allow core positions to grow as long as they obey price behavior. Repeat this cycle consistently. Over time, disciplined execution compounds gains while containing losses. Each fifth functions as a controlled experiment. Some will fail, some will succeed, but the net effect is sustainable growth. The visual metaphor of tree pruning reinforces the mental framework. Growth is never linear. Markets ebb and flow. Weak branches must be removed to ensure that strong branches flourish. Similarly, small losses, when excised quickly, preserve the integrity of the overall campaign. Compounding occurs not by holding everything, but by letting validated positions grow while cutting the unvalidated. Professionals embrace this natural rhythm. Amateurs resist it, clinging to flawed positions or chasing losses. This approach also solidifies emotional resilience. Knowing that each fifth is protected by its own stop frees the trader from fear of total ruin. The market may be volatile, but the framework contains risk. This allows clarity in decision-making, prevents overreaction, and reduces the psychological strain that causes premature exits or reckless scaling. The line in the sand is both a shield and a guide, providing structure in chaotic markets. Finally, the principles converge. Scale on proof, wait for confirmation, and cut quickly when the market disproves your hypothesis. Growth is compounded methodically. Losses are contained promptly. Time and patience become allies, not adversaries. Each fifth added and removed reinforces discipline, sharpens judgment, and transforms small wins into large ones. The process is iterative, measurable, and resilient to the psychological hazards that destroy so many traders. Here's your playbook distilled. Cut losses fast. Add small on strength. Wait like stone. Let time prove you right. Each fifth is a deliberate, evidence-based decision. Each pause is strategic. Each exit preserves capital and sanity. By executing this rhythm consistently, you replicate Livermore's greatest advantage, the ability to survive mistakes while maximizing validated opportunities. Waiting is still a trade. Cutting is still a trade. Adding is still a trade. Discipline transforms every decision into action that compounds both capital and confidence. This final chapter closes the arc by merging psychological mastery with mechanical execution. The line in the sand safeguards against ego, impatience, and hope. The 1/5 rule scales opportunities without overexposure. Waiting filters noise. Cutting preserves capital. The combination creates a resilient, repeatable framework for compounding wealth while maintaining professional composure. The paradox is complete. Disciplined subtraction enables growth, just as disciplined addition compounds it. If you found this lesson powerful, the next one, Livermore's Law of Confirmation, will take you deeper into reading the tape the way he did, building on scaling, patience, and risk control to refine your ability to act only when the market truly validates your thesis. The professional edge is never in guessing. It is in systematically letting the market prove itself, adding only when evidence is clear, and cutting without hesitation when doubt emerges. Mastery is in the rhythm of cut, hold, repeat.